There's something almost magnetic about the crowd. When everyone seems certain of what's coming next, when the news is good, prices are rising, and optimism fills the air, it feels foolish to stand apart. But Benjamin Graham, the father of value investing, spent his entire career reminding us that in markets, following the crowd is often the surest way to financial ruin. Graham's true genius didn't lie in inventing complex formulas or predicting the future. It lay in his temperament, in his ability to stay calm, rational, and independent when others were losing their heads. He understood that markets are not driven by logic alone, but by the shifting tides of human emotion, greed, fear, excitement, and panic. When I reflect on Graham's career, I see more than a legendary investor. I see a man who learned, through experience and humility, that the most valuable skill in investing isn't brilliance, it's independence of thought. He called this the art of the intelligent investor, to think for yourself, guided by evidence, not emotion, to act when others freeze and to wait when others rush in. That, in essence, is what we call contrarian investing. But Graham never saw himself as a rebel or a prophet. He wasn't contrarian for the sake of being different. He was contrarian because he refused to let the market's moods dictate his decisions. He bought when value was ignored and sold when speculation ran wild. And yet, this way of thinking wasn't easy for him. It was forged through hardship, through watching fortunes made and lost, through booms that seemed endless and crashes that wiped out entire generations of investors. In this episode, we'll journey through those defining moments. We'll see how Graham learned to recognize when the crowd had gone mad and how he built a disciplined approach to act rationally in irrational times. We'll also look at how his lessons apply to today's world, where hype moves faster than ever and independent thinking is harder than ever. Because while technology has changed everything about how we trade, it has changed nothing about how we behave. And that's where Graham's wisdom shines brightest. He showed us that the real edge in investing isn't found in algorithms or predictions. It's found in temperament, in the courage to stand alone when the world demands conformity. But Graham didn't arrive at this wisdom overnight. It was the roaring 1920s, a decade of excess and euphoria, that first tested his resolve and taught him just how dangerous the crowd can be. And as we'll see next, that era would set the stage for one of the greatest financial lessons in history. The 1920s were a time when the American dream seemed unstoppable. Factories were humming, cities were growing, and a new generation of investors believed they had discovered a permanent path to prosperity. Radio, automobiles, electricity, every technological leap sparked excitement, and the stock market became the stage for this newfound optimism. People weren't just investing, they were speculating. Bank clerks, teachers, taxi drivers, everyone wanted in. Wall Street was buzzing with confidence. The market only goes up, they said. This time is different. Graham was already a respected figure by then. As a young analyst and partner in his own firm, he watched the frenzy unfold up close. Companies were issuing stock at record pace, and investors were snapping up shares with little more than a rumor or a promise. Prices soared far beyond reason. But Graham, ever the realist, noticed something strange. Many of these so-called promising companies had weak balance sheets, inconsistent earnings, or no real business at all. Their prices rose not because of performance, but because of popularity. While others celebrated, Graham began running the numbers, and what he found disturbed him. Stocks that were supposed to be sure things were trading at valuations that couldn't possibly be justified by their actual earnings. He quietly reduced his exposure, trimming positions, holding more cash, and warning his colleagues that markets driven by emotion rarely end well. Few listened. To most, his caution seemed outdated, even pessimistic. Then came 1929. The euphoria that had fueled years of gains suddenly reversed. Prices didn't just fall, they collapsed. Margin calls spread like wildfire. Panic replaced confidence, and in a matter of weeks, fortunes vanished. Those who had followed the crowd were devastated.
Many lost everything. But Graham's restraint spared him from complete disaster. Though he wasn't untouched by the crash, his disciplined approach left him standing while others were swept away. What's remarkable is not just that Graham survived, but what he learned. The crash exposed something fundamental about markets, that mass psychology, not rational analysis, often drives prices. And when the crowd becomes convinced of one truth, the intelligent investor must at least question it. This was the seed of Graham's contrarian philosophy. He realized that markets swing like a pendulum from greed to fear, from overconfidence to despair. And the investor's job is not to follow the swing, but to stay anchored to reality. And this realization led him to a profound question. If the crowd could be so wrong at the top, could it also be wrong at the bottom? That question would soon guide Graham through the darkest years of the Great Depression, years that would transform his thinking and lay the foundation for value investing itself. Because it was in that chaos, when others gave up on stocks entirely, that Graham found the greatest opportunities of his life. But as he would learn, going against the crowd in despair was even harder than resisting it in euphoria. The early 1930s were unlike anything investors had ever seen. The Great Depression wasn't just an economic crisis, it was a psychological one. Confidence evaporated, banks failed, stock prices had fallen nearly 90% from their peaks. What had once been a nation of eager speculators became a generation of disillusioned savers. In that environment, the idea of buying stocks was almost laughable. Newspapers declared that Wall Street was finished. Never again, many investors said, swearing off equities for life. But for Graham, this was precisely the moment when his contrarian thinking began to take shape. He looked at the same market everyone else did, the same shattered prices, the same bankruptcies, the same despair, and saw something different. Beneath the wreckage of collapsed expectations, he found value. Companies whose shares were selling for less than the cash they held, less than the value of their real estate, even less than the worth of their working equipment. It wasn't optimism that guided him, it was arithmetic. He wasn't hoping for a rebound, he was identifying mispricing. He reasoned that if a company's shares were trading below the value of its assets, then even in a grim future, there was a margin of safety. And so, quietly, methodically, Graham began to buy. His peers thought he was insane. Why risk it, they asked. The economy is collapsing. Stocks are finished. But Graham's response was calm. If the facts justify the price, then the opinion of the crowd is irrelevant. It was during this time that he developed one of the most powerful ideas in all of investing, the concept of Mr. Market. Imagine, he said, that you are in business with a partner named Mr. Market. Every day, Mr. Market offers to buy your share of the business or sell you his at a different price. Some days he's euphoric, offering sky-high prices. Other days, he's depressed, willing to sell for next to nothing.
Your job isn't to argue with him, it's to take advantage of his mood swings when they favor you, and to ignore him when they don't. Through this metaphor, Graham captured the entire essence of contrarian investing. The market isn't something to predict or outsmart, it's something to observe and respond to rationally. He saw that the real opportunity for investors didn't come from following trends, but from recognizing when emotions, fear or greed, had distorted prices away from reality. That insight gave Graham a distinct advantage in the 1930s. While others were paralyzed by fear, he quietly accumulated shares in undervalued, overlooked businesses. When recovery eventually came, those same companies multiplied in value.
But Graham's success wasn't just financial, it was intellectual, a triumph of reason over emotion. He had learned that the key to profitable investing wasn't to predict the future, but to resist the impulses of the present. Yet, as powerful as this insight was, it came with a new challenge, one that every contrarian investor must face. Because standing apart from the crowd requires more than logic. It requires discipline. And as Graham would discover in the years that followed, discipline, not brilliance, is what separates the true contrarian from the reckless speculator. The difference, as he would soon show, can mean everything. Contrarian thinking may sound romantic, the image of a lone investor calmly buying while others panic, but Graham knew the reality was far more demanding. Independence was not a mood or a hunch, it was a discipline, a way of thinking that had to be trained and tested day after day. In the 1930s and 40s, Graham refined that discipline into a system. He realized that to truly go against the crowd, an investor needed more than courage. He needed structure. Emotion couldn't be trusted. It had to be replaced by rules, by principles that kept him rational when the market was anything but. And so Graham built what became the foundation of value investing, a framework grounded in valuation, quality, and margin of safety. He focused on the facts, the earnings, assets, and financial condition of businesses rather than the opinions of the market. He developed clear standards for what made a stock worth owning. If a company traded for less than its tangible assets, carried manageable debt, and had a record of stable earnings, it might be a bargain. If not, he passed it by. This discipline insulated him from the emotional noise that swayed most investors. He no longer cared whether the crowd was euphoric or terrified. His decisions came from analysis, not sentiment. One of Graham's favorite examples was a company that had fallen so far in price that its shares were selling for less than the cash sitting in their bank accounts. To him, that was the very definition of safety, not because the company was glamorous or growing, but because its value was undeniable, even if the market refused to see it. His approach worked, not because it was clever, but because it was consistent. Graham's partnerships achieved remarkable returns over time, particularly during periods when others were too afraid to buy. But what's most instructive is how he achieved those results through a systematic rejection of market emotion. Even when his holdings declined temporarily, he didn't flinch. He reminded himself that short-term price movements were not reality, they were reflections of mood. In the short run, he would later write, the market is a voting machine, but in the long run, it is a weighing machine. The discipline of independence to Graham meant anchoring yourself to truth when everyone else was drifting.
And this lesson has never been more relevant. In our modern markets, filled with instant information, social media sentiment, and algorithmic reactions, it's easier than ever for investors to lose that anchor. Prices swing wildly, headlines provoke emotion, and the crowd's voice has never been louder. But Graham would tell us the same thing he told investors nearly a century ago. You cannot outperform the market by thinking like the market. To achieve superior results, you must think independently, and that means sometimes you'll look foolish in the short term. In Graham's own career, there were long stretches when his methods were mocked, his returns questioned, and his ideas dismissed as outdated. But he didn't waver, because he understood something most investors never learn. It is far better to be temporarily wrong with reason than permanently wrong with the crowd. But Graham also discovered that the hardest part of contrarian investing wasn't about numbers or logic. It was about emotion, the battle within every investor's own mind. Because while it's one thing to know that fear and greed drive the market, it's quite another to resist those feelings when they rise within you. And for Graham, that realization would become the next great frontier in his philosophy, understanding the psychology of going against the crowd. Every investor likes to imagine they would stay calm when others panic. But when the crowd moves, when prices plunge or soar, something primal awakens inside us.
Fear and greed are contagious. They spread faster than logic. And resisting them requires more than intelligence. It requires emotional strength. Graham understood this long before the term behavioral finance ever existed. He saw firsthand how markets are mirrors of human nature, how the same instincts that drive crowds in politics, war, and fashion also drive them in finance. He once wrote, "The investor's chief problem, and even his worst enemy, is likely to be himself." Those words came not from cynicism, but from experience. In the dark years of the Depression, Graham often faced ridicule for his calm optimism. When he bought stocks trading at rock-bottom prices, colleagues called him reckless. They said, "Can't you see? The market is dead." But he didn't see a dead market, he saw a mispriced one. And when he sold stocks in the late 1930s after strong recoveries, those same people laughed again. They said, "You're too cautious. This is just the beginning." Each time, Graham smiled politely and did what his analysis told him to do. His emotions weren't absent. He felt the same fear and excitement as everyone else. The difference was he had trained himself not to act on them. He once likened investing to a test of character more than intellect. Success depended not on brilliance, but on temperament, on the ability to be patient, disciplined, and self-aware when everyone else was losing control. This, he believed, was the essence of contrarian investing. Not to oppose the crowd for its own sake, but to remain independent from its moods. And that independence requires a deep understanding of one's own psychology. It means knowing your tolerance for risk, your emotional triggers, your tendency to follow trends or seek comfort in consensus. In modern times, we see the same patterns repeating. During the dot-com bubble of the late 1990s, investors convinced themselves that profits no longer mattered. They called it a new era, echoing the same words Graham had heard 70 years earlier. And when the bubble burst, many of those fortunes disappeared overnight. Then came the 2008 financial crisis. Once again, panic took hold. Stocks plunged, fear dominated the headlines, and investors fled to safety. Yet those who remained calm, those who remembered Graham's lesson, found that the very companies everyone feared would fail became some of the best investments of the next decade.
The pattern is always the same. The crowd is most confident when risk is highest, and most fearful when opportunity is greatest. The contrarian must learn to reverse that instinct, to buy when fear dominates, and to hold back when greed takes over. But Graham also warned that contrarian investing is not simply doing the opposite of what others do. That's just reaction, not reason. True contrarianism, he said, means being guided by evidence, not emotion, even when that evidence aligns with the crowd. The point is not to disagree with others, but to think independently of them. It's a subtle difference, but it's everything. Because an investor who defines himself merely by opposition to the crowd is still letting the crowd set his course. Graham's independence came not from rebellion, but from reflection, from the quiet confidence of knowing why he made every decision. And that brings us to one of the most overlooked aspects of his philosophy, the balance between independence and humility. Because, as Graham would come to realize, the danger isn't just in following the crowd. The danger is also in believing you're smarter than it. Graham's success as a contrarian was not built on arrogance. In fact, it was grounded in humility, the recognition that even the best analysis can be wrong, and that markets have a way of humbling anyone who grows overconfident. He once said, "The intelligent investor is a realist who sells to optimists and buys from pessimists." Notice the balance in that statement. It's not emotional, not self-congratulatory, it's pragmatic. Graham didn't seek to prove he was smarter than the market.
He sought to act rationally when the market was not. Humility was the foundation of his independence. He taught that a contrarian must have conviction, the courage to stand apart, but also the flexibility to admit when new facts emerge. Blind defiance of the crowd is just as dangerous as blind obedience. In the mid-1940s, this humility was tested again. After years of depression and war, optimism returned to Wall Street. The U.S. economy was expanding rapidly, corporate profits were rising, and investors began to believe the worst was behind them. Graham's analysis showed that while many stocks were now fully valued, few were outright bargains. Yet the crowd was euphoric again. And once more, he faced the temptation every investor knows, the fear of missing out. But Graham resisted. He reminded his students and readers that the intelligent investor does not measure success by the market's applause, but by the soundness of his reasoning. He sold overvalued positions, built cash reserves, and patiently waited. And when the market corrected again in the early 1950s, his discipline paid off. While many others lost their hard-earned gains, Graham's approach, cautious, deliberate, contrarian, allowed him not only to preserve capital, but to redeploy it at better prices. It was this balance, conviction tempered by humility, that distinguished him from speculators. He had the strength to act against the crowd, but also the wisdom to question himself. Graham warned that ego is one of the most dangerous enemies of the investor. Once you begin to equate market success with intelligence, you stop listening to the market's lessons. He wrote that the market is there to serve you, not to instruct you. Its job is to offer prices, sometimes generous, sometimes foolish, and your job is to take advantage of them, not to imitate them. That idea, simple yet profound, is what separates the investor from the speculator. The investor remains independent, guided by analysis and reason, while the speculator is forever chasing the crowd's approval.
In today's markets, humility is even harder to maintain. Information moves instantly. Trends rise and fall within hours. Every investor is bombarded by opinions, data, and noise. The temptation to act, to react, is constant. But if Graham were alive today, he would likely tell us this: the tools have changed, but human nature has not. The crowd still moves in cycles of fear and greed, and the contrarian still finds opportunity by stepping outside of those emotions. True independence, he would say, begins with humility, with knowing what you don't know and being content to wait until the odds favor you. And that, perhaps, is the most difficult art of all, the art of doing nothing when everyone else is doing something. Because contrarian investing isn't just about buying what others hate. It's about having the patience to wait for the right moment, even when the world insists that you act. And as Graham's career drew toward its later years, he would distill this entire philosophy into one of the simplest and most enduring principles in all of finance, a principle that still guides investors to this day. A principle about markets, behavior, and the quiet courage to think for yourself. In his later years, Graham had achieved what most investors could only dream of. He was respected, wealthy, and regarded as the father of an entirely new discipline, value investing. But what's fascinating is that Graham grew less interested in beating the market and more interested in understanding it. He often reminded his students, including a young Warren Buffett, that the market isn't an opponent to outsmart. It's a partner whose moods you must learn to tolerate. This was the essence of his greatest metaphor, Mr. Market. Imagine, he said, that you own a small business with a partner named Mr. Market.
Every day, Mr. Market comes to your door and offers to buy your share or sell you his at a different price each time. Sometimes he's exuberant, offering sky-high valuations. Other times he's depressed, offering to sell his share for far less than it's worth. Your job is not to argue with Mr. Market or follow his emotions. Your job is to recognize when his offer makes sense and when it doesn't. That story, simple as it sounds, captures the entire philosophy of contrarian investing. It's about recognizing that the crowd, Mr. Market, is not always rational. Sometimes he's driven by fear or greed. Sometimes he's blind to value or obsessed with fantasy. And in those moments, the intelligent investor has a choice. You can either be swept along with him or you can stand apart, calm, analytical, patient. Graham's students often said he invested with a sense of detachment, almost serenity. He wasn't indifferent to loss or gain, but he refused to let emotion make his decisions. He saw markets as a reflection of human nature, endlessly shifting, sometimes wise, often foolish. And his great contribution was to show that you could build success not by predicting those moods, but by preparing for them, by buying when value was clear and selling when it wasn't, regardless of what others thought.
That's what makes Graham's wisdom timeless. His teachings weren't about quick profits or clever trades. They were about discipline, independence, and emotional control, virtues that never go out of style. In today's world, contrarian investing might seem harder than ever. Social media amplifies every voice, every opinion. The crowd has become louder, faster, and more persuasive. Yet the core challenge remains exactly the same: to think for yourself in a world that rewards conformity. And that's why Graham's lessons still resonate, because being contrarian isn't just about money, it's about mindset. It's about valuing truth over popularity, reason over emotion, and patience over excitement. He taught us that real wealth isn't built in moments of euphoria, but in moments of calm, when others are distracted and you are focused. So when the next market mania arrives, and it will, remember this: the crowd will always chase what shines, but the intelligent investor will quietly seek what's real. As Graham once wrote, in the short run, the market is a voting machine. In the long run, it is a weighing machine. Those words remain a compass for every investor who dares to think independently. Because in the end, the art of contrarian investing is not about defiance, it's about discipline. It's not about being different for the sake of it, it's about being right when it matters most. And that, perhaps, is the greatest legacy of Benjamin Graham. He taught us that to stand apart from the crowd is not an act of arrogance, but of wisdom. So as you look at today's markets, the noise, the trends, the endless predictions, ask yourself, am I following the crowd or am I thinking for myself? That single question may be the most valuable one an investor can ever ask. Because as Graham proved time and again, the road to lasting wealth is rarely the crowded one. It's the quiet path, paved with patience, discipline, and the courage to stand alone.